I want to start off with the current state of play. Of course, a lot of the news recently, when you think about alternative investment more broadly, you think of the crypto crashes and everything else that's kind of colored the news, perhaps around the dangers, especially in this environment. But I want to get your views. Are these the sorts of crypto crashes that we've seen? Are they isolated, sort of Darwinian, market changes, or is there something to look at here that's kind of coloring the alternative investment landscape more broadly?
Yeah, so you mentioned crypto, maybe NFT and other types of alternative investing. So this is going to sound a little old school, but at Blackstone, we are the largest alternative asset management firm in the world with over $900 billion of AUM, but we don't do any of those. So I'll leave the venture part to Vishal, but what we do is, what we focus on really is on the private markets. When it comes to private equity, we have a traditional buyout strategy that has a 35-year track record. We have life sciences, growth equity, and a few more others. But what I would take the opportunity to highlight two areas. One is private real estate, and then the other is private credit. Because in a cycle like this, you want to own inflation-resistant, real hard assets. That's U.S., for instance, the private real estate market is doing pretty strongly compared to this. S&P was down 20% in the first half of the year. Even listed REITs were down 20% in the first half of the year. But then private real estate has been posting positive performance. So that's one area. And then the other one is private credit that we're focusing a lot on. Being one of the largest non-bank lenders in the U.S., we focus on senior secured floating rate, privately originated debt. So the private market actually needs a lot of financing. So we stay focused on that. So those two are a lot more about what we do.
So you've outlined a lot of assets kind of in this bucket, which I do want to get into at the top, so we're just clear about what we're talking about when we talk about alternative investment. Yeah. Vishal, do you want to also add to that? We've got NFT, crypto, structured products and funds, private equity.
The plan was to throw Herbert under the bus and get him to take all the crypto questions, but perhaps to
derailed.
Remove ourselves like a few levels of abstraction and look at it from the top down. All we do is venture at 500 Global, right? We've done about 2,700 investments across 80 different markets over the last 12 years. And so as investors that are investing into this asset class that is bringing about and birthing the new technology companies that are shaping the way we live, the way that we work, the way that we play, our view has always been to go back to first principles in times like this. So first principle number one, do we believe that this is cyclical or not? And if you do believe that it is cyclical and it's something that has happened before, and it happened in 2010, it happened in the 2000s during the tech crash, tech bubble, it's again manifesting itself right now. For us, the way that we see it, to borrow what Jim Rogers said in the panel before this, is what is the opportunity that presents itself in bear markets? So when you're talking about the private space, especially in venture, one of the questions we ask ourselves are, where are deals to be had? Where are valuations being squeezed? Because regardless of the time, great entrepreneurs will continue to build phenomenal companies across market cycles. In fact, some of the best companies have been birthed themselves in times like this, and the most innovative companies, Dropbox, Slack, GitHub, Credit Karma, tons of companies have been born during these times. So we're on the hunt for opportunities like this and are taking advantage of the fact that some of the valuations have come down to invest aggressively from idea to IPO in companies in the space.
Well, whether it's more cyclical or perhaps structural, can you give us a sense, any of you, about the allocation switch from traditional to alternative investing? How big a deal is this right now? Crypto is not obviously just a flash in the pan, but the alternative investment universe is much bigger than that, as we've outlined. So where are we moving into, alternative investments that might actually become traditional soon?
I think, I'll start. And it depends on who you ask. If you're speaking to a sovereign wealth fund, so we work with a lot of institutional investors in the world. If you look at the allocation, GIC, for instance, is one of those that is publishing the asset allocation information on the website. So this is literally public information. You could see that from 2021 to 2022, the allocation to private equity increased from 15% to 17%, and then real estate allocation increased from 8 to 10.
Mm.
So the two asset classes together represents 27% of GIC's portfolio.
Mm.
That's a typical sovereign wealth funds allocation. And then if you look at pension funds, maybe ranging from 20 to 30% in alternatives. And endowment funds actually tend to have a bigger allocation to alternatives, maybe 40, 50%. That's a big contrast to individual investors who typically we have like below 5% allocation to alts. Actually, a lot of people are still not fully aware of the benefits of including private market exposures in their portfolios. That's sort of the landscape we're talking about.
I think just to add on to what Herbert said, the view tends to be this. If you think about alternative investments historically, and I'm going to speak from the perspective of venture because that's where my expertise is, you assume or associate the word alternative with unknown, with opaque, with risky. And I think what's happened over the last 10 years is a few things, which is why we're seeing a deluge of capital coming into the alternative space. The first is that there's a lot more expertise in the ability to underwrite the asset in alternative investments. So the sophistication and familiarity of LPs, of investors with venture, for example, as an asset class has increased significantly. Much of that is a function of knowledge, right? Now, when you're speaking with asset allocators, many of them are familiar with, for example, David Swenson's strategies that he used to run at Yale and how he used to allocate to venture, which was something that was previously unknown. The second is that there's just so much information available online, right, that is accessible about venture, the media, the press. Everyone is talking about the fundamental or the atomic unit of venture, which are startups and technology companies, which leads to a greater interest in people, especially as there are generational shifts in asset allocators into who's managing that money, who's underwriting the deals, and who's deploying the capital in wanting to understand and participate in a much less opaque and much better understood universe in alternatives.
So then it becomes traditional someday.
And so then it kind of, today's alternatives are tomorrow's traditionals, you know?
Well, I want to bring the commissioner in who joins us from the US. Thank you for taking the long journey and looking as high energy as any of us today, even after a long flight. So we do want to get into a bit on the regulation side. Essentially, where is it needed? Where can it help the consumers in terms of regulation of alternative investments? And what are investors actually asking for guidance on? Perhaps they want some of these rules. I mean, if we can get into a few specifics, obviously there's investment caps talked about, leverage caps, the role of exchanges that seem to be doing everything right now, license versus, regulated entities. I mean, tell us what rises to the top of your list right now and what specific rules and regulations you think are most important?
Yeah, sure, of course. So I think there's a couple ways to approach that question. So first of all, I should give my disclaimer that the views I express today are just those of my own and not those of the CFTC or my fellow commissioners. So when you look at the crypto ecosystem, and in particular what people are calling the current crypto winter, what you're seeing is the failure of risk management. And with the crypto market volatility, it's really exposed those who had not strong business models or who really were not on top of their risk management and were over leveraged or didn't have a good grasp of their exposures, or quite frankly, some of whom were engaging in fraudulent practices. And so I think this is where strong regulation is necessary, because we have seen these types of cycles before where you have a new or emerging industry. It's not subject to the types of strong regulations, particularly for financial institutions or financial services firms. And unfortunately, sometimes what does happen is you end up with investors or consumers who are left holding the bag. And so that's why in the United States, what you've seen is an attempt, and not just in the United States actually, but all around the world, and particularly with the international standard setters, to bring the crypto sector within the regulatory perimeter. And so there's two ways that you can go about this. First of all is making sure that the firms in the crypto ecosystem do have minimum financial resource requirements, are required to adhere to risk management standards, are required to engage in credit underwriting and manage their credit risk, do have to provide some transparency and some disclosures and reporting about their operations and their financials. And so all of those things, again, are pretty run-of-the-mill, but for this sector, they've not been doing that. It's just not been required, particularly when you do have a patchwork of regulation, whether it's in the United States or in other jurisdictions. Besides that, the other piece that's very important is investor protection and just generally what we would call retail protections. Now, in the global wealth segment, because that is more of an institutional or sophisticated asset class, I do think that the types of investor protections should be tailored, which is similar, for example, in the United States to what we have with the different types of investors, whether qualified or accredited or what have you. So I think, first of all, disclosures are so important. I think everybody who's wanting to make an investment decision must make sure that they have the information necessary that would be material to an investor. But then there's also suitability requirements. And so I do think that's a spectrum. You would want to look at, for example, for your sort of run-of-the-mill retail investor, you would want to make sure you have some suitability requirements. And then I think investor education is extremely important. But again, these are not new concepts. These are things where if you take what we have that's existing, and there is a huge debate, of course, right now over particular types of crypto assets. And for those that are not just merely a tokenized financial instrument, so the tokenization of real assets, then sometimes you do have a question, is this something that's truly novel, or is it just another format really for the investment? So one of the things in the United States that was actually just released, I believe yesterday, by the US Senate Agriculture Committee is the Digital Commodities Consumer Protection Act. And this is a pretty comprehensive act which builds upon the existing regulatory framework for the CFTC. But that has proportioned the jurisdiction between the CFTC and the SEC. And here it's making sure that that whole ecosystem has to come in and register, whether as a broker or a dealer or some kind of trading platform, and that there are the minimum retail protections in place. And I think in particular, to your point, conflict of interest requirements. You really do have a huge problem, and again, we've seen this time and time again, where the incentives are not aligned, and where you have somebody who's providing a service and you don't know, are they acting more in an agency capacity, or are they really a principal and a counterparty to you? And so I think those things are important, and of course, information barriers. But to me, I keep saying this is really getting back to basics.
That applies a lot to the exchanges you're talking about.
Absolutely.
So, I mean, you come from the private banking world. What do your friends in that former life tell you that they want to see, or what do they complain about when they say, "Hey, you know, can you get this changed, or can you get regulators off our back on this issue?" I mean, what's the feedback from the private banking world?
So what's really been surprising to me, but maybe it shouldn't be surprising, is how much people really do want regulation, and they really are looking to have things be clear and transparent. I think the people who are not looking for regulation are probably those who are somehow taking advantage of it in some way because of the conflicts of interest, because of the information asymmetry, you know, those types of issues. So I think this really pulls upon, you know, what my co-panelists were discussing, in that there is the search for yield, and not only the search for yield, but also the search for uncorrelated diversification. And so people were looking at the crypto sector as perhaps a way to do that, but then you've seen some reports come out where really it is actually it is highly correlated with equities. So I think this is going to be important to dig into.
But just to add to that, I think it's highly relevant what Caroline just shared. One thing is to wait for regulations to come through. I think the other thing is, being the biggest player in the industry, it's a self-directed mission that we have to try to share more information, so to push for more transparency. And just to give you one example, we launched, so one of the biggest vehicles that we have that does private real estate investing, that we launched about 6 years ago. We chose to use a highly regulated structure by will it's literally a REIT structure. So the fund itself, we have to file the 10Ks and 10Qs, full public filings, just like any other public companies do. But we did not want clients to be exposed to public market volatilities. So we kept that private. It's a privately traded structure, but then at the same time providing a very high degree of transparency and disclosures. And that's one big component of it. And you also touch on the other one is probably understated, is super important, is education, right? So providing the information is one thing, helping investors to comprehend, you know, instead of asking to go through all the public filings that we have, just really like educate more investors about what we do, how we do things. That's mission critical. We put a lot of resources at Blackstone doing that.
I'm gonna take an unpopular and controversial opinion on this. Ventures contrarian here. It's all about that. I think when people want regulation, what you really want is certainty. And the reason why regulation is so needed is also to create rules of a game that you have. I think what's happening in crypto as an asset class is that it's on the cusp of innovation, right? People are feeling out an ecosystem. It's messy. It's not neat and tidy in its boxes that can be easily managed. And when you want people to be creative and you want them to be innovative, and you're designing what is fundamentally a new asset class and economic incentive system, you've got to give people some freedom to innovate. And what happens is regulation then catches up. The downside is there are, of course, going to be charlatans. There are going to be, of course, troublemakers and mischief makers, and fraud is going to be perpetuated at some part of that. And that's where the protections are necessary, which is the participants in the ecosystem, especially the end consumers and customers, should be fully aware of what the risks are for this new and frontier asset class that they're participating in. But if you're an entrepreneur that's in the space, and if you're an investor that's looking at it, innovation should be encouraged. And the only way that you're going to learn about it, and the only way you're going to see what gets generated, is if you allow new companies to be built and created, and then take and try and find a good way to underwrite that risk and protect, of course, the stakeholders involved. But I think that's the framework in which we're playing in crypto. So the swings that we're seeing right now aren't so material, I feel. It's just the process of innovation as it's being felt out. And it's going to take a little bit of time.
So we need the rules of the game, but I want to, off one point that you said, I want to ask about consumer behavior in all this. And we were talking earlier about NFTs. I still, for the life of me, maybe I'm too old school, I cannot envision what sort of bragging rights I would have if I got an NFT. I clearly won't be investing in one. But I mean, this is someone who collected baseball cards when I was younger. Tell me, what is the point of an NFT? What do investors, what do consumers think that they're getting out of it? And is there something here that is dangerous on a larger level? Do they know? Are they educated? Are consumers sufficiently aware of the risks in these
Do you
asset
own an
classes?
NFT?
I do not.
Do either of you have an NFT?
I tried to buy one, but it was difficult. That's the whole thing. You have to remember your customer experience, your user experience.
Out of pure curiosity in this audience, like just random show of hands, how many of you own NFTs?
NFTs out there. Oh, decent.
It's not bad. Look at that. And
Maybe
then
we're able to figure it out.
you've always got to add the 10 or 20% that are too shy to say that they've got it. So the numbers are always going to be a little bit higher than what you see in the audience because I don't want this other person to know that I have an NFT. It's a giant experiment in a new way of proving ownership. I think the tricky part about what's happening with NFTs right now is, I mean, there are many analogies, right? It's like having an online version of baseball cards, or I think Carolyn had mentioned when we were talking earlier, Beanie Baby collection, but digital, right? Like something like that.
That was your bet, right? Back in the day.
Yeah, that was my big thing, Beanie Babies. And so it's a new way of right now it's just manifesting itself as a way to show collectibles and then to almost gamble on the future value of them. The difficult time that NFTs are having, I think, compared with the rest of the crypto ecosystem is that it's not growing at the same rate. And I think it's because people are struggling to find a utility value that's above just having a collectible on the one hand, and the second, getting more of the same asset once you have it, which is, like just getting airdrops or things like that, because you can get that in other classes. So the novelty is kind of wearing off.
Right.
And what people are really hunting and looking for is, okay, now what is the utility of this that I can use it for? In some ways, it's for membership to various clubs, participating in certain DAOs or, like institutions like that, but still on the hunt.
Maybe others are having problems with the commissioner.
But I think this is very interesting because I've been doing a lot of learning about Web3 and the metaverse, because if I'm going to regulate something, I think that first of all, I should understand what it is that I'm regulating. It seems basic. And then also to really future-proof the regulations. One of the things about the way you discussed the approach to regulating innovation, and this is why many have said that the CFTC would be the more suited regulator in the United States for this, is because it is right in the CFTC statutory mandate that we promote responsible innovation and fair competition. And so we have a principles-based framework for that. But looking at NFTs and looking at Web3 and the metaverse, and frankly, just looking at my daughter during COVID when she had to stay at home and how she was hanging out with her friends, she was doing it on Roblox. There is an increasing segment of the population, particularly amongst the younger set, I think maybe your 9 to 12, but then also up to your 18 demographics, where they spend an increasing amount of their time online, whether it's in a gaming world like in Fortnite, which actually people are just socializing and hanging out in Fortnite, or whether it's Roblox and others. And just like when you hang out with your friends and you want to show that you have like the latest sneakers, for example, people want to buy these collectibles, these intangible digital assets, and it's something that they like to show off. It's just like any other consumer behavior. The other thing that I think is interesting with innovation and technologies, oftentimes you do see that in either the consumer sectors or in media and entertainment. And I think that's what we're seeing with NFTs. First, you're seeing people experimenting with it there, and then we'll see if it moves on to other applications. But one of the things about Web3 that is critical that people are trying to solve for is digital identity, is the piece that really you need to make a true metaverse or Web3 experience work. It's something that is secure, that is safe, that is portable, and has privacy built into that digital identity. So I think this is going to be very interesting, and NFTs may be part of that technology to provide that value proposition.
So there could be some durability here.
Yeah.
Herbert, you don't own an NFT, do you?
No, I think this panel is super interesting. As we here at Blackstone, we're just as old school as it gets. We're in the same camp.
You need to excuse yourself to make a trade. That's what
So, because Caroline, you mentioned earlier about like clients might be looking for differentiated, uncorrelated types of assets in their portfolios. You mentioned about people seeking yield. So we just find different ways to provide that kind of exposures, like private credit. We lend to companies. We know what the business is about. We underwrite a loan, and having it senior secured, yielding more decent than the public market, and at the same time having the protection of being senior secured and floating rate in nature. I think that's some good exposures to include in the portfolio. And well, digital asset. Well, we are among the very few that we didn't even touch spec. I mean, that's. People don't really talk about it these days, but we keep an eye on all these new trends at the same time, because we're safeguarding a lot of like pension capital. So we tend to go more old school, I would say, like playing that online theme. We are a big believer in e-commerce growing over time. That kind of mega trend, we actually own a lot of like last mile logistics assets in the US. So people still have to put the goods on the shelves, right after all. So something tangible, it's what we are focusing a bit more on.
Well, I want to ask, I know we've defined alternative investment pretty broadly, but in the short and medium term, when we're looking at the world, and we talked with Jim Rogers about the macro environment right now, high inflation, strong dollar, a lot of uncertainty. In this environment, do you see more people flocking to alternative investments in that search for yield we talk about, or is it so uncertain, and this is another uncertain asset that people are holding off and waiting around? What is the trend right now and into 1-5 years into the future?
Thank you, Herbert. Look, I think the trend is quite unstoppable, and that's more assets are being allocated to venture in terms of a proportional portfolio allocation. It's going to dip and drop, and some people are going to withdraw money when they get skittish if they don't understand or can fully underwrite the asset class at times like this. But in general, it's a forward and unmistakable march towards a greater allocation to asset classes that are across the board. So the question is not really about whether you should allocate, it's about how much, knowing that it is increasing over time. So when we talk about new things, I love what like both Carolyn and Herbert said earlier, which is that when you come to things even like NFTs, and that's a bit of an extreme example, no one is suggesting anyone bet the house on it, that you put 80% of your portfolio strategy into buying a bunch of apes, right? Not a great strategy to have if you're an asset allocator or an investor. But it would also be wrong for you to not at least try to see what that ecosystem is like, because it may present what the future of investment asset classes are. And now that you're able to just experiment and understand and learn what it's like, just like Carolyn's daughters are doing it on Roblox, we should as well. And so highly encourage everyone at the end of this forum. It's the simplest thing in the world. Go back home, take an hour, buy an NFT just to see what it's like. It can be worth $1. It doesn't matter. And I think that's how you learn about new asset classes, understand what they're like, and then slowly figure out whether there's a space for this in your portfolio. And NFTs are a bit of an extreme example, but it applies to venture, it applies to private equity, it applies to any other asset class that you think may be a little bit exotic or esoteric. learn about it, understand it, and take a few low risk sort of like investments or bets in those sectors just to learn what the game is like.
Okay, and then blame Vishal if things go wrong.
And then send your bills to Herbert. Allocate your capital with Blackstone.
And I really appreciate what you're saying, because the question that I've been asking, and many people have been making this analogy, is, you know, NFTs that are collectibles, isn't that just more like those in the wealth segment who might be looking at doing art, for example, diversifying and investing in art, and that is something that's uncorrelated. And so I think if you're the kind of person who, you know, your risk appetite and what you're looking for is to do something like getting into more esoteric new artists, right? That if you're like that kind of investor, then maybe an NFT is that type of thing that you might want to look into. But nothing I say is investment advice. So.
But I was just trying to summarize a little bit. So I think it's a combination of finding something different from stocks and bonds. This is a good year to start doing that, because it doesn't matter what the mix is, it's not working. So you want alternatives. And then you look through a little bit, the landscape is pretty broad. So it's investors, they want assurance, they want transparency, something that they can understand. That's why we do see a pretty strong, you know, take up in terms of adding alternatives in this portfolio overall. But you know, when it comes to then what do I do? It's also a function of how much liquidity do you want to preserve. So in our case, we believe nobody needs to liquidate a whole portfolio at 4 p.m. every day. No one needs 100% of your liquidity all the time. If you can afford to trade away some of the liquidity, then you can start looking into some of these less liquid assets, like private markets, whether it's private equity, venture, or private real estate, private credit. So that's how we would look at, you know, where to start.